All right, let's talk through how these deals are, middle market deals are financed. So generally within private equity, the way that they're going to finance the deal, and it depends on the industry, but they're usually they're going to lever you up, put some debt on there, and maybe 30 to 50% of the transaction price is going to be financed through debt. So again, the buyer is going to go grab some debt, and then the rest of it's going to be through equity infusion. So when we're looking at some of the numbers here, the average debt was 3.1 times EBITDA. So for example, if they bought your business for, let's say, an 8x multiple, 5 out of that 8x is going to be equity or cash. The other 3 is debt. So that's how they're financing the purchase of you. And the average interest rate was 8.1%. So what that means, and that kind of then ties the loop of why and how interest rates impact valuation and why valuations were so high in 2020 and 2021, because these private equity companies could essentially borrow money at 4%. And so as long as you could get a higher rate of return of essentially that 4% from operating this business, why would you not just take on a bunch of debt? So then therefore they'd be willing to pay more. But now as interest rates have gone up, it's a higher hurdle rate that they need to clear in order to make money on these deals. So again, 8% is the average interest rate that these PE firms were borrowing at in the first half of 25. And then 3 EBITDA turns was the average amount of debt that they're putting on there. So I know we've seen some business owners levered up as part of these deals. There's some risk there. Maybe fill in some entrepreneurs on some things they need to be thinking about if they're selling to private equity and understanding the cap stack that the private equity team's coming in.
Yeah,
with.
and one good point about this is the reason why there are fewer deals. Because if all of a sudden you're going to be borrowing money at a much higher interest rate, you're going to be much more careful about when you make a purchase.
Yep.
As opposed to if your interest rate is so low, 3 or 4%, then you are going to do more deals, because if you're wrong, you don't have as much of that debt service that would come into play.
Yeah, and I know that there's I've seen multiple entrepreneurs that were bought out by private equity companies. They lever the debt on. This was really happening from deals that were struck in 2020, 2021. And we actually have a chart here that shows the increase in interest rates, the senior debt interest rate, which was 6%, got down to 4% during COVID, spiked to 11% in 2023. This is all floating rate debt. So if they were underwriting the model at carrying the interest at 4.5%, now you're running a business, you've got to pay based off your operating business, you've got to pay this debt service back and based off your debt service coverage ratio. And then if the interest rates are going up by 2.5 times, not 2.5%, but 2.5 times, then a lot more cash is going out the door just to float the debt. So that has caused multiple bankruptcies where the private equity companies over-levered the acquisition company, put too much debt on it, interest rates balloon up, they can't afford the debt, banks now foreclose on assets.
Yeah, and if you're listening and you know real estate, that's pretty much the recipe of what happened with multifamily in the last few years.
Yeah, nope, spot on. Last chart we got here is just going to be the EBITDA turns of senior debt multiples in blue. And then also there's something called mezzanine debt, which is just going to be extra debt that's going to be generally unsecured. And so this is where there's a lot of private credit lending going on the investor space. A lot of that is really the flip side of this mezzanine debt, that yes, there's a borrower there, which is going to be generally a company that's getting bought out, but you're usually second in line to get paid back. 12.1% is the average interest rate there. When you include warrants and payments in kinds, PIK, 16% is the total cost of this mezzanine debt. So that because it's going to get paid out in a default scenario after the primary debt, because they get what's left over, they have to charge a lot higher interest rate to cover themselves because of all the extra risk that's being included on here. So interesting just to see that.
Yeah, this would imply that as interest rates go down, we'll see more deal flow and more deals happen. Would you agree with that?
Yeah, I would agree. I think there's the other variable there is what's taking interest rates down. If it's a macroeconomic pullback and then there's issues with the consumer, then if you're a CPG or some sort of brand, you may face headwinds, right, from your own industry. But yes, if it's just kind of a traditional rate cutting cycle, which we tend to be in now with unemployment still holding strong and inflation not too high, then yes, that just decreases the cost of capital. That'd be good. Buttoning up this topic. So again, business owners, if you're selling, if you are a well-run business, valuations are holding steady. I know we're going through multiple transactions with clients right now. The valuations for these well-run businesses, north of 5 million EBITDA, looking really good, right? High single digit, low double digits, but they're very well-run businesses. So if you are not a well-run business, the heyday of 2020, 2021, and you think you're worth 8 to 10x is gone. Your business is probably not even sellable. So start working on building that enterprise value.
And by the way, this is a good motivation to get your company where it runs well, because whether you're going to sell it or you just want to have a better life and make more money, having a well-run business checks both those boxes.